That was Fed Chair Janet Yellen today, saying that the Federal Reserve is indeed worried about bubbles forming in the market. Still, the U.S. Central Bank left rates unchanged after today's meeting, which came as no surprise to our next guest, who said earlier this week that the Fed would deliver a hawkish no hike. Jeffrey Gundlach is CEO and founder of Double Line Capital, which is $105 billion under management. He's known to many on Wall Street as the Bond King. He joins us now in an exclusive interview. Jeffrey, welcome to the show. It's a pleasure to have you.
Thanks, Melissa. Greetings from, this is our debut performance, for me anyway, from the Double Line Media Studio.
Oh, excellent. It's looking good, Jeffrey. Looking good.
Yeah.
What do you make of what Janet Yellen said today? Has much changed from 24 hours ago in your view?
Not much has changed, because as you correctly pointed out, we saw this coming in terms of no hike with a little bit of a lean towards hawkish language. I think one of the interesting things that happened, unfortunately, was the downgrade of long-term economic growth from what was already a downgraded level of 2% to 1.8%. It's really getting kind of low in terms of the growth expectations. You'll remember years ago, every year they said it was going to be 3%. They've capitulated all the way down to 1.8, which is pretty much in line with what reality has been for the past 6 or 7 years. It's interesting today how the Fed's rhetoric and their economic projections and even their forward interest rate projections have gone down to a fully capitulated level of where the bond market pretty much saw it back in January of this year. One of my webcasts, the January 8th one, Just Markets, which is up on replay at doubleline.com, we said the Fed would be forced this year to capitulate and meet the market's expectations in terms of future rate hikes down at the lower levels, and that happened today.
So do you think that a Fed hike in December is all but a foregone conclusion? I mean, have the markets gotten that part right? Or is the fact that the 3 dissents on the Fed is the highest level of dissension within the Federal Reserve since 2014, does that throw a wrench in that thinking that December is on the table?
Well, I think the 3 dissenters reinforces the potential for December. But I think December is a huge who knows at this point. You know, just think of how many times and the magnitude at which the Fed guessing for today's move, or non-move, changed over the past 3 months. And here we've got 3 months, which includes 3 presidential debates, a presidential election. This is highly unknown, what's going to happen in December. And so I'm not surprised that the WIRP function that shows the embedded probability of the Fed moving from the short end of the bond market is right about 50%. Because that's probably what any rational person would put the odds at, because there's too much wood to chop economically and politically between now and December. But the Fed, the 3 dissenters, you know, it shows that there is a growing mood at the Fed that at some point they have to follow through with these interest rate increases. So some people thought the Fed might shock the market today. No way. With the WIRP down at 22, the bond market saying 22% probability, that's just too frightening for the Fed to shock the market with that type of level. I'll tell you what, though, Melissa, if the WIRP is in the 40s, it doesn't have to be at 70 like it used to be in the old days, or 60. My guessing is even if the WIRP is in the 40s, the Fed will raise interest rates in December. In fact, they want the WIRP to be in the mid-40s to raise interest rates in December, because that's the only way that they can say, you know what, we're not just following the market. We're not a machine. We have a reason to exist. We can raise interest rates when the bond market doesn't exactly give us permission to do that. But with the WIRP at 22, where it was today, no chance they can deliver that kind of a shock.
WIRP, by the way, for those at home who might not be familiar, World Interest Rate Probability Index. Instead of just saying WIRP. So what should we expect between now and December then? I mean, if one would think perhaps that there'd be a lot of Fed speak coming out, trying to get that WIRP reading a little bit higher so it could be more justified by December, and does that then yield volatility in the markets?
Well, I think there's going to be volatility in the markets, but I think many analysts have kind of got anachronistic in their thinking. For years now, we've had quantitative easing, strange interest rate policies, even negative interest rates in various places, and I have the suspicion that that environment is not going to be with us forever, that in fact it's already on the cusp of change. And I think what the markets are going to need to digest isn't yet another 3 months of us guessing every day what a speech from a Fed official means, but rather understanding that there's a growing awareness in Europe and Japan, and I think indeed in the United States, that these policies have not generated the results that they were designed to generate. Yesterday, people were saying, watch out for the BOJ. That's going to be the big market mover, and no one's even talking about that today. They said they would, but they aren't talking about it. But something interesting did happen at the BOJ, and that is they sort of admitted that they're not getting the results that they're hoping for from negative interest rates, and indeed, they might want to steepen out their yield curve and get to positive interest rates. Interest rates have already bottomed on a global basis back in July. The Japanese JGB, the 10-year, was at negative 30 basis points. It's now negative low single digits. The German Bund actually yields 1/10 of 1 basis point positive, having been negative 23 or so. So U.S. 10-year was down at 132 July 6th, and it got up to above 1.7. It's at 1.65 now. Rates have already risen by 20 or 30 basis points on a global basis. And the reason, I think, Melissa, is the bond market is sniffing out a pivot to fiscal stimulus, which is now being talked about much more than it was even 2 weeks ago, let alone a year ago. And fiscal stimulus, I think, changes the game. I think that you get a different kind of a mentality about policy and interest rates. And I think interest rates bottomed in the United States in a secular basis way back in July of 2012. But on a shorter-term basis, with the 10-year pushing to a minor new low on July 6th, I think we've seen the bottom in interest rates for this year anyway, and maybe for this cycle, because a pivot to fiscal stimulus is fundamentally bond unfriendly.
And I do want to get your thoughts, Jeffrey, on what you think of the candidates' infrastructure plans, but I want to also get your call on the markets more broadly. You made some excellent spot-on market calls recently. For instance, at the end of July, you came out and boldly said to sell everything. The markets haven't really, S&P that is, hasn't really gone very far from there. So what do you anticipate now that the environment has, in fact, changed here?
Well, I think that the markets have been delicately balanced on the concept of low interest rates forever. I heard people saying in July that interest rates can never rise. I've been at this game a long time, and I've learned that when you hear the word never, it means it's about to happen. So with all the markets balanced on zero interest rates or very, very low interest rates, the interest rates rising will cause downside volatility. So that was kind of the impetus behind that statement, sell everything, which of course is a code word for saying get defensive, reduce your duration in bond portfolios, upgrade your credit quality, put less into risk assets. And it's right that the S&P is a little bit lower now than it was then. It hasn't made any progress since then. There's a gap in the S&P from that Friday a few weeks ago when a Fed official said they're going to raise rates twice this year. There's a gap in the S&P up at around 2180 or so. I suspect the S&P will find its way back to fill that gap. Markets almost always fill gaps, and I think that's a great selling opportunity. I think interest rates are headed higher. I think the 10-year will make it up into the low twos before year end, and therefore I think the market's balanced on forever, 1.5 or lower 10 years are balancing on unsteady ground. And so I'm looking for downside volatility to develop. Also, I think that relates to the election. It seems clear that Mr. Trump has momentum. You know that I've been saying all year that Trump was going to be our next president, even when he was an asterisk, even just the Republican race. And he seems to have momentum now. And if he goes ahead, and he certainly has a monumental opportunity on Monday to really gain further momentum. Also, I would acknowledge he has the opportunity to blow himself up on Monday. But if he does a good performance, I think he's going to pull ahead in the polls in a kind of a definitive way, which will not be greeted with open arms from the mainstream media, which likes to run negative articles on Mr. Trump virtually every single day. And so they don't want him to win. And so there's all kinds of stories. And it leads to kind of a fear concept of the world's going to come to an end because Trump might win. I could see that adding to downside volatility as well.
Okay. So there are some market thinkers out there that believe that prices, particularly in the equity markets, have been pumped up by the Fed a certain percentage. A certain percentage is embedded in the market simply because of the Fed's QE program. In that when the Fed stops, which is basically now, that is going to unwind. Are you in that camp that a certain percentage in the markets has to come off because the Fed is pulling back?
Sort of. I agree with kind of broadly with that line of thinking, but QE ended a while ago. I mean, QE ended at the end of 2014. And so what was interesting, one of the most incredible charts, if you run it for the past decade, is the relationship of the S&P 500 and the size of the Fed's balance sheet, which grows because of QE. So when they were doing QE, you had huge gains in the S&P 500 correlated with the growth of the Fed's balance sheet. From the beginning of QE, and it was on and off again, but from the beginning of QE in 2009 to the end of QE at the end of 2014, the S&P 500 advanced by 17% per annum. That's when QE was happening. When they stopped QE at the end of 2014, since then there's been very little progress. The S&P 500 has probably done about 3% per annum. So QE has been replaced with negative interest rates in other countries and some QE in other countries, but QE has stopped the United States. I do think that the PE ratio of the stock market should be high as long as interest rates are very low. But interest rates have started to rise. So that should put some pressure on the PE ratio. And also profits have been really disappointing versus forecasts for about 7 years in a row now. Every year, forecasters, the consensus entering the year is earnings are going to grow from 10 to 12%. And instead, they come in at 5%. And that was 5 years ago and 4 years ago and 3 years ago, all of them 5%. And then they come in at negative for 2015, and they're not looking all that spiffy for 2016, but lo and behold, the forecast is for double-digit earnings growth in 2017 and double-digit earnings growth still in 2018, really kind of heroically ignoring what's been happening. And wage increases do not help profitability. So absent growth in nominal GDP. So it seems to me that there's a reason for the PE to be rather high, but those reasons are starting to erode. And therefore, I do think that there's a certain percentage, not so much based on QE, which is ended, but based upon low interest rates and zero interest rate policies, which seem to be in the process of perhaps being reversed as we look forward, being replaced by fiscal stimulus as we look forward maybe 9 months to a year. And so I think that percentage that the market might be too high by, you know, it could be 10, 15%.
And you would anticipate that coming out?
I think so. I really think that the rounding top pattern in the S&P that was punctuated with a sharp gap to the downside is a negative. I would become particularly negative, and then I would be looking for a 15% drop if we put a couple of closes in below 2138 on the S&P 500. That's a very specific number, but it has to do with what, I think it was 2132 actually. 2132 was the high close before the minor new high that we saw in recent months. That was the high close several quarters ago. And when you go to a minor new high and then you reverse it, in essence it's a rejection of the new high. That's what happened to the 10-year by analogy here in July into September. The 10-year was a 138 low back in 2012. It pushed down to 132, so a minor new low yield, but then very quickly was back above 138 and even back above 160. That's what you call a rejection of a exhaustion move in a market, or a throwover in very jargony technical terms. If we put in two closes below 2132 on the S&P 500, particularly if we accelerate, then I think we are in the teeth of a correction, looking for about a 15% down move. So I've been playing risk assets, the S&P 500 type of assets, all year on the short side in a macro fund that I run, and we're up massively in that fund year to date, even though we're on the short side, because this market has lots of momentum things going on, but it also has pockets that are really weak. And most of those pockets that are weak have to do with consumer discretionary. And I think consumer discretionary is a place that one should be short. And I've been making money on the short side in names that went up massively in recent years. But the consumer discretionary story is a bad story right now.
Such as, and you remain short those names?
Yeah, I don't like talking about individual names I'm short, but I've been short some restaurants, I've been short some airlines, I've been short some retailers, and basically most of these stocks are down 15 to 20% year to date.
Jeffrey, thanks so much for joining us. We do appreciate your time.
Thank you, Melissa. It's good to be here. Good luck.
Jeffrey Gundlach of Double Line Capital coming to us from their brand spanking new studio here. So a lot to unpack here in terms of direction of the markets, which we can see a 10 to 15% correction. Shorts that he has on currently. What stood out to you?
Well, listen, he talked about 10 to 15% corrections. The last time it happened at the end of QE, late 2014, like you said, and then also at the end of the zero interest rate policy, which happened last December. So if he is correct that by the end of the year, we have the 10-year yield at 2.2%, that's where it was last December when they had their first rate increase in 9 years, then there is a very good likelihood if people start pricing in a higher Fed fund rate somewhere near 1% the first half of 2017, then you have a 10 to 15% correction like he's talking about.
He was clear on two things. One, reflation trade is what you still want to be in, and I still think that works with resources, some of the rails, some of the EM markets. He also said the rates higher, and he said this before, is not good for credit. And so if you look at high yield, and we've had this conversation on the desk before, be careful on that. But the 2132 number, very interesting. I'm sure a lot of people will be pouring over that one because I think it's an important technical.
All right. Coming up, hedge fund titan Leon Cooperman charged by the SEC for insider trading, and a top attorney says the case is strong, very strong. He'll be here to explain why. Plus, Netflix shares down after a new report that says subscriber growth is shrinking. But could original content save the company? We will explain, and much more fast straight ahead.